Hey, it's Andrew with the Above Average Investor Podcast. Today, we're expanding on our stock market investing series. So, today we're going to talk about what is the stock market, help you understand what that even means. So, first off, that's investing in publicly traded companies. Those are what are included in the stock market. And so, when you drive down the your local main street, when you go downtown and in whatever area or community that means to you, you're going to see a lot of these brand names that you recognize. You're going to see the Targets, the Walmarts, the Home Depot, Papa John's, Visa, Delta Airlines. Those are publicly traded companies as opposed to privately held companies. So maybe your neighbor owns a contracting business or a roofing business or a physical therapist business. A lot of small, medium, or large companies are privately held. A lot of the medium to large companies are publicly held. So that means you and I, the public, are able to purchase a small fraction of that business. So if you have enough funds, of course, you could purchase a larger percentage of the business, but you can purchase 10% of the business, 1%, 0.1%, 0.00001% of the business. And that's what it means when you're buying a stock. Historically, they used to give you a piece of paper that says you owned one share of this business. A lot of times now, one share is too small of a part of the company. They're not going to actually mail you a letter for each share of the business, but same concept. It's buying a publicly traded company, just a small fraction of it. So then when you purchase that portion of the company, you get the right to that percentage of the company's profits. So when you invest in the S&P 500, some examples are Disney. You go and help pay for those rides and you get a share of the ride income. Delta Airlines, you help buy airplanes for Delta and then you'll get a portion of the flight income. Chipotle, crowd favorite, when you'll buy 1,000 chickens or 100,000 chickens for Chipotle, and then you'll get a share of the profit of their burritos. Sherwin-Williams, a lot of you will drive by your local Sherwin-Williams where you can buy paint. You'll help buy paint by the million gallons, who knows, and then you'll get a profit of those paint profits coming back to you. You'll buy lumber for Home Depot and power tools, all of that. You'll buy software or software engineers for Visa, for Google, and you'll help build those systems that we all use, and then you'll get a share of the Visa profit. So that interest that you or I may or may not pay, you'll get a cut of that back to you, which is not an encouragement to get credit card debt if you own stock market shares. McDonald's, you'll buy whatever meat or food goes into McDonald's food, into the chicken nuggets, and you'll get a chunk of the profit coming back from the chicken nuggets. So when you're investing in these businesses, it's just like being an owner, and all of the employees are in some sense working for you. They're working to make sure that the business stays alive and generates long-term profitability. So the CEO, the middle management, the people on the front line doing the real work, all of those people are working to provide their own livelihood, but also to grow the business, and that's working for you as the owner. So all of those employees are your employees in some sense, and that's a mindset shift that really helps me. They're all little worker bees diligently working on your behalf as the owner. And so this is really the idea of being an absentee owner business. It's acting like the stock market where you just put money in, you help buy the equipment, help pay for whatever the employees need, and then they go to work and you get leverage on their time. The whole is greater than the sum of the parts. So 1 + 1 can equal 3, or one employee can generate an income of or a revenue of more than their salary, which makes sense from a business perspective. So some years, different industries do better than others. During COVID, the airlines did not do well. During 2008, Home Depot, home developers did not do well. But also within those industries, whether the industry is doing well or relatively poorly, individual companies within the exact same industry can do better or worse. Just like your neighborhood roofing company or Walmart or Target do better than one another, or Napa versus AutoZone. One of those is going to do better this year, and maybe that switches next year. Or American Airlines and Delta Airlines are having wildly different years so far, profitability wise, in 2024. There's a lot of factors in that I don't even begin to understand. I just see the results at, where the proof is in the pudding, per se. So that's the value of diversification, or diversifying your investments. So when you invest in the stock market, which I explained in a previous video, is just a big list of companies, of publicly traded companies that you share in the profits with. You get the winners, you get the so-so, and you get the dogs, or you get the losers. And on average, all of those companies are working in a competitive, unforgiving marketplace. And you vote with your dollars. So you may see folks protesting out on the sidewalk or on Facebook, whatever that does, but the proof is in the pudding. So if you invest your money, you are voting for that company's to exist in the future. And so when some people vote a certain way and then spend their money in a different way, they're literally keeping that business alive financially. So that's where one way where your vote can really count, and in whatever the cause is. I'm not trying to imply anything here, but that's where your vote can count to help vote for these businesses and these industries to exist in the future. So if you like travel, continue to support the airlines. I personally like Delta. Continue to support the airline of your choice, and they will likely stay around in the future, so you can continue to buy their goods and services. So what's really hard is to try to predict the future within the stock market. Talk is cheap, they say. And so instead of investing in a wide range of companies, for example, the S&P 500 or the NASDAQ or the Dow, why not just pick the winners and throw away the dogs, ignore those? And so what's really hard is you've got to be right twice. And if you're right once and wrong once, it can really handicap your results and even degrade to where you're losing a lot of money. I personally have lit on fire thousands of dollars investing poorly in the stock market. And so that's where I'm trying to help download literally dozens of investing books and simplify them into practical strategies and techniques and mindsets to help you all learn faster than I did, and take my experience and just short circuit all the dumb decisions that I made in investing. So it's really hard to predict the future, to predict your crystal ball. If you could do that repeatedly over time, you will be a billionaire. Like, you will fly by $1 million, fly by 10 million, fly by 100 million. If you look at any compound interest calculator, and you're getting 10% per year in the stock market on average, and you're getting 20, 30%, you will have an ungodly amount of investments in a short period of time. It is, but I don't know how to do that, so I'm not trying to imply that I do. I know nothing. My crystal ball is completely broken. So some things that I think help bring this to life is Peloton during COVID, the airlines during COVID. Some of them went sky high to the moon, and then they came back down pretty hard. Same with a lot of the tech stocks. So this year, some things that I just want to show you, the S&P 500 is having a great year, despite the news saying everything about a recession coming every single year. But I just want to throw out some examples, and if you can predict the future, or you can explain why these were so obvious, I'd love to hear in your comments below. But Intel is down 36% per year. Nvidia is up 77% per year. SMC is up 200% this year. I mean, year to date in 2024. Same computer technology industries, wildly different returns. Home Depot's at -3%. That hasn't really gone anywhere. Tractor Supply, which is different than Home Depot for sure, is up 27%. Delta is up 24%. American Airlines is up 1%. Tesla is down 32%. I thought electric cars were the new fad. Lululemon's down 28%. That's a market I know nothing about. But Walgreens is down 32%. Amazon's up 18%. GM is up 27%. So what's really nice with the stock market with a blended diversified index fund, which is investing in the S&P 500, for example, you get all the winners, you get all the losers, and on average, the top 500 companies do pretty well long term. And so that's how the stock market works, and hope this was helpful to some of the listeners to help understand what does it even mean when you're investing in the stock market and who are you betting on. And so those are just different company examples, and all of those companies are companies, when you invest in the S&P 500, you're buying a portion of that business. All of their employees are working for you in some sense, and you're getting a cut of all of their profits. And so what's really nice is there's so many different industries, multiple competing companies within the same industry, and they're all working for you. I think it's just wild how that works. So thanks all, and we'll catch you in the next video.